Cryptocurrency has rapidly emerged as a disruptive force in the global financial landscape. Since the introduction of Bitcoin in 2009, the crypto market has expanded significantly, with thousands of digital currencies now in circulation. As of 2023, the total market capitalization of cryptocurrencies was estimated at over $1 trillion, a testament to their growing influence. Blockchain technology, the foundation of cryptocurrencies, has introduced new possibilities for decentralized finance, DeFi, peer-to-peer transactions, and financial inclusion. The future of money? Suppose that you live in a world where you no longer need a bank to manage your money, where transactions are instant and borderless, and where financial systems are decentralized, putting control back into the hands of individuals. This is the vision that cryptocurrency enthusiasts advocate for, a future where digital currencies replace traditional financial systems. But is this future realistic, or is it just a utopian dream? This leads to an important question. Can cryptocurrency realistically replace the established financial system, or will it remain a niche asset class with limited influence? To answer this, we must explore the potential of cryptocurrencies, the challenges they face, and their current impact on traditional finance. The potential of cryptocurrency and decentralized finance, DeFi. To understand whether crypto can replace the traditional financial system, it's essential to examine the strengths and limitations of digital currencies, as well as their adoption and integration into existing financial structures. This analysis includes the potential for decentralized finance, DeFi, the challenges of regulation and security, and the practicality of widespread adoption. One of the most compelling arguments for cryptocurrency replacing traditional finance is its potential to revolutionize how financial transactions are conducted. Decentralized finance, or DeFi, is a movement within the crypto space that aims to create a financial system without intermediaries, such as banks or brokers. By leveraging blockchain technology, DeFi platforms enable users to lend, borrow, trade, and invest in assets directly, often at a lower cost and with greater transparency than traditional financial services. For example, platforms like Uniswap and Aave allow users to trade cryptocurrencies or earn interest on their holdings without relying on a central authority. These platforms have experienced rapid growth, with the total value locked, TVL, in DeFi protocols exceeding $100 billion at its peak in 2021. This growth highlights the demand for alternative financial services and the potential for DeFi to disrupt traditional banking and investment sectors. Moreover, cryptocurrencies offer the promise of financial inclusion, particularly in regions where access to traditional banking is limited. With a smartphone and internet connection, individuals in developing countries can participate in the global economy, send and receive money, and access financial services that were previously out of reach. This democratization of finance could lead to significant social and economic changes, furthering the case for crypto as a replacement for traditional finance. Challenges: regulation, security, and stability. While the potential of cryptocurrency is significant, several obstacles must be overcome before it can replace traditional financial systems. One of the most pressing challenges is regulation. Governments around the world are grappling with how to regulate cryptocurrencies to prevent illegal activities, protect consumers, and maintain financial stability. The lack of consistent regulatory frameworks creates uncertainty for both users and institutions, hindering the widespread adoption of cryptocurrencies. For instance, in 2021, China banned all cryptocurrency transactions, citing concerns about financial stability and illegal activities. Similarly, the U.S. Securities and Exchange Commission, SEC, has increased scrutiny of crypto markets, particularly in areas like initial coin offerings, ICOs, and decentralized finance. These regulatory actions highlight the tension between the decentralized nature of cryptocurrencies and the need for oversight in the financial system. Another significant challenge is security. While blockchain technology is inherently secure, the crypto ecosystem is not immune to hacks, fraud, and scams. High-profile incidents such as the hacking of the Mt. Gox exchange in 2014 and the $600 million Poly network hack in 2021 have exposed vulnerabilities in crypto platforms and eroded trust among potential users. For crypto to replace traditional finance, these security issues must be addressed to build confidence in digital assets. Additionally, the volatility of cryptocurrencies presents a major hurdle. Bitcoin, the most well-known cryptocurrency, has experienced dramatic price swings, from under $1,000 in 2017 to nearly $70,000 in 2021 before falling sharply again. This volatility makes cryptocurrencies risky as a store of value and medium of exchange, limiting their practicality for everyday transactions. For cryptocurrencies to be viable replacements for traditional currencies, they must achieve greater stability. Adoption and integration with traditional finance. The adoption of cryptocurrency by mainstream financial institutions is another key factor in determining whether it can replace traditional finance. In recent years, there has been a growing trend of integration between crypto and traditional finance, with major companies and institutions beginning to embrace digital currencies. For example, payment giants like PayPal and Square now allow users to buy, sell, and hold cryptocurrencies, bringing digital assets into the mainstream. Additionally, several large banks, including JP Morgan Chase and Goldman Sachs, have launched cryptocurrency trading desks or are offering investment products linked to digital assets. These developments suggest that rather than replacing traditional finance, cryptocurrencies may become an integral part of the existing financial system. However, widespread adoption still faces significant barriers. Many people remain skeptical of cryptocurrencies due to their complexity, perceived risk, and lack of understanding. Moreover, the infrastructure needed to support mass adoption, such as scalable blockchain networks and user-friendly interfaces, is still in development. Without addressing these issues, the likelihood of crypto replacing traditional finance remains uncertain. To illustrate the current and potential impact of cryptocurrencies on the financial system, let's examine a few case studies that highlight both successes and challenges in this space. Case study number 1. El Salvador's Bitcoin adoption. In 2021, El Salvador made headlines by becoming the first country to adopt Bitcoin as legal tender. The government promoted Bitcoin as a way to increase financial inclusion and reduce remittance costs for the millions of Salvadorans who rely on money sent from abroad. The rollout included the launch of a national digital wallet, Chivo, and the installation of Bitcoin ATMs across the country. However, the adoption of Bitcoin has been met with mixed reactions. While some Salvadorans have embraced the digital currency, others have expressed concerns about its volatility and the lack of infrastructure to support its use. Additionally, international organizations like the International Monetary Fund, IMF, have warned of potential economic risks associated with adopting Bitcoin as legal tender. This case study highlights both the potential benefits and challenges of integrating cryptocurrency into a national economy. Case study number 2. The rise of stablecoins. Stablecoins, a type of cryptocurrency pegged to the value of a fiat currency, such as the US dollar, have gained popularity as a way to address the volatility of traditional cryptocurrencies. Tether, USDT, and USD Coin, USDC, are two of the most widely used stablecoins, with billions of dollars in circulation. Stablecoins are increasingly used in DeFi applications, cross-border payments, and as a bridge between traditional finance and the crypto world. Their stability makes them more practical for everyday transactions and has led to increased adoption by both individuals and institutions. However, stablecoins also face regulatory scrutiny, particularly regarding their reserve backing and potential impact on financial stability. This case study illustrates how innovation within the crypto space can address some of the challenges associated with digital currencies while also raising new questions. Case study number 3. Institutional investment in Bitcoin. The growing interest of institutional investors in Bitcoin is another example of the integration of crypto into traditional finance. In 2020 and 2021, several high-profile companies, including Tesla and MicroStrategy, made significant investments in Bitcoin, signaling a shift in how digital assets are perceived by the mainstream financial community. These investments have provided legitimacy to Bitcoin as an asset class and have driven its price to new heights. However, the volatility of Bitcoin remains a concern, and some institutional investors have taken a cautious approach, allocating only a small percentage of their portfolios to digital assets. This case study demonstrates the potential for crypto to coexist with traditional finance, rather than replace it entirely. In conclusion, the question of whether cryptocurrency will replace most of the traditional financial system is complex and multifaceted. While crypto and decentralized finance offer significant potential to disrupt and transform financial services, several challenges must be addressed before they can fully replace traditional finance. These challenges include regulatory uncertainty, security concerns, volatility, and the need for broader adoption. Rather than a complete replacement, it is more likely that cryptocurrency will continue to integrate with and complement the existing financial system. The rise of stablecoins, the adoption of digital currencies by national governments, and the growing interest of institutional investors all suggest that crypto will play an increasingly important role in the future of finance. However, traditional financial institutions are also likely to adapt and evolve, incorporating digital assets into their offerings while maintaining their core functions. The future of finance may therefore be a hybrid model where traditional financial systems coexist with innovative digital currencies and decentralized platforms. Whether this will lead to a more equitable and efficient financial system remains to be seen, but it is clear that the rise of cryptocurrency is already reshaping the financial landscape in profound ways.